Hello, everyone. This is Mark with Semantics Research with an intro to a series on valuation. We will hope to cover a broad spectrum of topics like competitive advantage, discounted cash flow, and other various related things. And in this series, we will go over the basics. Now, valuation can be described akin to a craft like cooking or carpentry. Rather than being a science that adheres to immutable laws, the principles of valuation do not have the precision of science, but on the other hand, it is not an art which is on the other extreme, as art is a highly subjective thing and one could create their own rules based off of creative instinct. So you could say it's quite in the middle of things, rather. We must take a look first at the company's financial statement in order to find out if the company is a potential gold mine that is worth investing in, or is it a mediocre business that has many factors going against it. We will break down the financial statements into three types. The first being the income statement, which tells us how much money the company has earned in a set period of time. With this income statement, you could look at the company's margins, its return equity, and its direction of its earnings. The second type of a financial statement is the balance sheet, which tells us how much money the company has in the bank and how much it owes. If you were to subtract the money it owes from the money it has, it gets you the net worth. Things such as how much cash the company carries and how much debt are key indicators of a company's health. And finally, there is the cash flow statement, which tracks the cash that flows in and out of the firm. The cash flow is necessary to see how much the company is spending on capital improvements and also bond and stock sales and repurchases. In a modern age of internet, there are many places to access a company's financial statement. You can find it on Yahoo Finance, Wall Street Journal, or any other financial website. Now, let us talk briefly about durable competitive advantage, which is when a company has business economics that has attributes almost like a monopoly, which allows them to charge more or sell more of the product or service in their industry. What makes a company's competitive advantage durable also is being able to maintain their solid business economics for long periods of time. While in the near term, you may see players who irrationally drive down the price of a company's stock under its intrinsic value, and eventually the market tends to acknowledge its value in the longer term.